You know that feeling when you hear people talking about the market and it sounds like a totally secret language? Well, today we're giving you the decoder ring. We're going to pop the hood on one of the most powerful economic engines on the planet. It seems so incredibly simple, right? It's just a tap on your phone. But behind that one little click, there's this enormous, complex, and fascinating world. So let's pull back the curtain and see what's actually going on. Okay, at the very heart of all of this is one simple, powerful idea: investment. It doesn't matter if you're buying one share of a company or a whole factory. You're putting your resources to work right now, all in the hopes of getting more back in the future. This idea right here, it's the fuel for the entire system. So to really get how that engine works, we have to start with the two fundamental pieces that make up the economy. On one side, you have real assets. This is the actual physical stuff that makes things and provides services. We're talking factories, machinery, buildings, even intellectual property and knowledge. And on the other side, you've got financial assets, stocks, bonds. Think of them as the paper, the contracts that represent a claim on all that real stuff. And here's the magic connection. When you buy a financial asset, like a stock, your money helps a company build more real assets. That's it. That's how wealth is actually created. The easiest way to think about the financial markets, imagine a giant supermarket. Seriously. But instead of picking out milk and eggs, you're shopping for places to put your money to work. So you walk into the supermarket, right? And there are two main aisles. The equity aisle is where you buy stocks. This means you become an owner, you get a slice of the company's pie. Then you've got the debt aisle. This is where you buy bonds, which is basically you giving a loan to a company or a government in exchange for an IOU that pays interest. So, do you want to be an owner or do you want to be a lender? That's the core choice. All right, let's grab a shopping cart. It's time to take a closer look at the actual products on the shelves in those two aisles. First up, stocks. And the most important thing to remember is that a stock is a piece of ownership. Common stock is the standard. You own a tiny piece of the company and share in its fortunes, good or bad. Preferred stock is a little different. It's kind of like a subscription that gives you a fixed regular payment. And then you have things like mutual funds or ETFs, which are basically pre-made shopping baskets that hold tons of different stocks all at once. Now, on the other hand, we have bonds. With bonds, you're not the owner, you're the lender. Think of it like you're the bank. You're giving a longer-term loan to a corporation or even the US government, and they promise to pay you back with interest. It's a completely different kind of investment with a totally different risk profile. Okay, so you've decided what you want to buy. Now, how do you actually, do it? Let's talk about the mechanics of making a trade. You really have two fundamental stances you can take. The first one is simple: going long. It's what we all think of. You buy something, you own it, and you make money if the price goes up. But you can also go short, and this is where it gets a little wild. You actually borrow a stock you don't own, sell it, and then hope the price plummets so you can buy it back for cheaper and keep the difference. You're betting against the company. Now, when you decide to make your move, you have a few ways to place your order. A market order is all about speed. It's you telling your broker, I don't care about the exact price, just get me this stock right now. A limit order is all about price. You say, I'm only willing to buy if it hits this price, or I'm only selling if I can get that price. And a stop-loss order is all about protection. It's an automatic escape hatch that sells your stock if it falls to a certain price, saving you from bigger losses. Okay, now we're getting into the advanced tactics, the power plays. These are two strategies that can seriously amplify your results, but they can also get you into a world of trouble if you don't know exactly what you're doing. So let's do a quick pop quiz. Remember that short selling thing we just talked about? Okay, so you short 100 shares of a stock at $40 a share. You're betting it's going to go down. So what is the absolute most money you could possibly lose on this single trade? The answer is unlimited. Yep, you heard me right. Not $4,000. Your potential loss is infinite. So wait, how is that even possible? Well, think it through. To close out your short position, you have to eventually buy back those 100 shares on the open market. Now, a stock's price can only fall to zero, right? So your profit is capped.
But there's no ceiling on how high a stock's price can go. What if it goes to $100, $1,000? You're on the hook to buy it back at that price, no matter how high it gets.
The other side of that high-risk coin is buying on margin. It's a pretty simple concept. You're just using borrowed money from your broker to buy more of an asset than you could afford with your own cash. And the key thing, the only thing you need to burn into your brain is that it magnifies everything. Your wins get bigger and your losses get way bigger.
Let's just look at an example. Say you want to buy $12,000 worth of stock. You only have $7,000 of your own money. So you borrow $5,000 from your broker. Your own money, the $7,000, is your equity. Right now, everything's looking good. But watch what happens if that stock just drops by 25%. The value of your assets falls to $9,000, but you still owe the broker that $5,000 loan. That doesn't change. So look at your equity. It's cratered from $7,000 down to $4,000. Let that sink in. A 25% drop in the stock price caused a massive 43% loss of your cash. That is the brutal power of leverage. So with all this buying and selling and leveraging going on, how does anyone keep track? How do we know if the market had a good day or a bad day? Well, we use a market index. Whenever you hear a news anchor say the S&P 500 was up today, that's what they're talking about. An index is basically just a curated basket of stocks that's used as a benchmark, a scoreboard, to give us a snapshot of how one part of the market is performing. But here's the catch. Not all scoreboards are calculated the same way. In a price-weighted index, the stock with the highest price per share shouts the loudest. In an equal-weighted index, every company gets one vote. It doesn't matter if it's a giant or a startup. But the most common by far is market cap weighted. Here, the biggest companies have the most power. And this shows you exactly how that works. In a market cap weighted index like the S&P 500, a huge $200 billion company like Big Corp is going to have a much, much bigger impact on the index's value than Medco or Smallco. A small move in Big Corp's price means way more than a huge move in Smallco's. So there you have it. The assets, the markets, the actions you can take, and the scoreboards we use to keep track of it all. These are the fundamental building blocks of the entire financial world. You now know the rules of the game. So, what's the first question you want to ask?